Yep, quite a few actually this morning. So I'll start with the first one. You mentioned this, but given that the Fed's motto is consistently wrong on growth, what are the odds that Yellen remains hawkish? It wouldn't be the first time the Fed has miscommunicated its intentions to the market.
Well, that would be a total head fake versus every article you've seen from Reuters to the Wall Street Journal and back again in the last 2 weeks. I think Hilsenrath actually had to write 2 articles in the last 2 days just to repeat what it is that the Fed's going to do. So again, I've said this a lot of times, but it's important to acknowledge from a behavioral perspective. Janet Yellen is a raging bureaucrat. She likes to cross the T's and dot the I's. So again, she wants to communicate as effectively as she possibly can to Jan Hatzius to push out the dots. In other words, push out the expectations of interest rate hikes for the U.S. into the back half of next year or into 2016. So all the communicating that you see from Fisher to Yellen to poor this guy Kucherla-Cota, he's going to be dovish until he's dead. But the reality is that this is what's going on out there, and I don't think that I think there's a very low probability that she is hawkish coming out of these meetings or through the September meeting.
Yep, moving along. It says CPI slowed in July and housing starts ripped to over 1 million annualized units. If these data points morph into a trend, i.e. inflation decelerating and housing accelerating, how much would you anchor on what would be happening sequentially versus the year-over-year compares?
Well, that's like I'm going fishing on Thursday and Friday, and that's really fishing for a data point on housing. I mean, that's one positive data point in a mess of mud. I mean, that the housing data is decisively, whether you look at purchase applications or prices, which are the biggest leading indicators, by the way, for housing demand, not some NAHB housing guy survey, or your own in-house survey. That, by the way, I think Ed said that this morning his survey confirmed that survey. So again, I got a survey. The housing stocks suck year to date. Now that's a survey. I mean, if you look at it for what it is, I think at the end of the day, the only thing that's going to fix housing is lower prices. Low single-digit year-over-year gains in housing prices. We might even get bullish on housing like we were for the last 3 years on that. I'm in no hurry to do that, and I'm certainly not looking for fish finder data points on that. And I think there was another part to the question, but I was ranting, so I didn't.
I just mentioned that CPI slowed in July.
Yeah, great.
And then lastly, bond fund managers have record cash positions on an expectation for rate hikes in 2015. Given how bad bond fund managers have become at forecasting rates, particularly over the last 2 years, does that make you supremely bullish on bonds?
Oh, supremely. I've never used that word.
Indeed, you haven't.
I am supremely bullish on bonds when consensus is looking for rate hikes.
Absolutely.
We were supremely bearish on bonds when consensus wasn't looking for rate hikes in 2013. We go both ways in bonds. It gets us in trouble.
We'll wrap it up there, folks. Thanks for joining us this morning. Catch you back tomorrow, same time. Have a great day out there.